Long, long ago, in a bustling city where merchants haggled over spices and scribes meticulously copied scrolls, lived a wise old scholar named Luca. Luca wasn't just any scholar, he was a master of numbers, fascinated by the intricate dance of wealth in the city. He observed that many merchants, despite their hard work, often struggled to truly understand their financial standing. They'd note down money coming in and money going out, but it was all a jumble, a single winding path that made it impossible to see the whole picture. One evening, as the sun dipped below the horizon, painting the sky in hues of orange and purple, Luca had a revelation. He imagined every financial transaction not as a single event, but as two interconnected forces, like the push and pull of the tides. He called this revolutionary idea the double-entry bookkeeping system. He began to teach his method to a young, eager apprentice named Elena, who owned a small but growing textile shop.
Helena, think of your shop as a grand ledger, a book with two mighty columns. On one side we have debits and on the other, credits. For every action in your business, there must be an equal and opposite reaction.
But Master Luca, if I sell a bolt of silk for gold, isn't that just money coming in?
But that's where the magic lies. When you receive gold, your cash account, which is an asset, increases. To record this increase, we debit the cash account. But where did that gold come from? It came from the sale of your silk, which represents revenue. To record an increase in revenue, we credit your sales revenue account.
Elena diligently followed Luca's instructions. When she bought new dyes, she would debit her inventory, another asset, and credit her cash or accounts payable, a liability if she hadn't paid yet. When a customer paid on credit, she debited accounts receivable, an asset, and credited sales revenue. And when she paid her assistant, she debited wages expense and credited cash. Slowly, Elena began to see the brilliance of the system. Each transaction, like two sides of a coin, was recorded in two separate places. This seemingly simple act created an intricate web of interconnected accounts.
Now, Elena, let's look at your balance sheet.
He showed her how her assets, what her business owned, always perfectly balanced with the sum of her liabilities, what she owed others, and her owner's equity, her investment in the business. The formula was elegant: assets equal liabilities plus owner's equity. And then there was the income statement, which showed her the profit or loss of her business over a period. It was here that her debits to expenses and credits to revenue truly came to life, revealing the story of her shop's financial performance. The beauty of Luca's double-entry bookkeeping system was its inherent self-checking mechanism. If the total debits didn't equal the total credits at any point, Elena knew there was an error, a misplaced entry that needed to be found. It was like a compass that always pointed true, guiding her through the often treacherous waters of commerce. Soon, other merchants in the city, seeing Elena's flourishing shop and her clear understanding of her finances, began to seek out Luca's wisdom. The double-entry bookkeeping system spread like wildfire, becoming the bedrock of sound financial management for businesses large and small. And so, the legacy of Luca and his ingenious double-entry bookkeeping system lived on, ensuring that every financial transaction, no matter how small, told a complete and balanced story, guiding generations of merchants to prosperity. Let's wrap it up. Double-entry bookkeeping is an accounting system where every financial transaction is recorded in at least two different accounts, ensuring that the fundamental accounting equation, assets equal liabilities plus equity, remains balanced.